What is equity research within an investment bank? Woo! Hello and welcome back to another video here on HB Does Life. And yeah, before we start, please subscribe, like, share, comment, all that good stuff. Hopefully you're finding these videos actually informative. And yeah, let's just keep going, man. I want to just say thank you to everyone who has been supporting as well, because honestly, it's kind of overwhelming, the fact that you guys want to listen to me when I don't know why. But yeah, hopefully I can teach you some stuff along the way. And yeah, this is obviously part of the careers bit of the channel. I do also have Dime Drop, and I have my vlogs as well. I'm also going to be introducing some gaming content potentially, because I'm going to start streaming just very briefly, nothing too much, and just showcasing different bits of my life. We're also going to be launching a Miram YouTube channel for the business as well, which is going to be more like food content and bars and things like that around London. So stay tuned for that. I will be linking all of it on my socials, mainly on TikTok, because I know that's where most of you follow me. Right, anyway, let's get into this. So I've been asked by a fair few people about what do I know about equity research. So I'm going to do probably 3 videos on this kind of stuff. So because there's equity research, investment analyst, and then we're going to do one like a difference between the two. So primarily equity research is on the sell side. So that's part of the investment bank. Investment analyst roles are generally on the buy side. I'm going to cover, like I said, the differences and everything in a different video, but I just wanted to set the scene there. So equity research, where does it sit? It's actually it is a front office function. Now, when people think about front office within an investment bank, they think about M&A. M&A is the first thing that comes to people's minds. You do have M&A, you have ECM, you have DCM, and I was working in that sort of function when I was in investment banking. So I can talk about that quite well, I think, because I did loads of different deals when I was in there. However, the other side, that's usually, so every bank kind of works differently. The bank I was at, everyone who was in M&A, ECM and DCM and sponsors, we all sat on the private side of the wall. We were all like had inside information, all of us. Now, on the other side of the wall, which were also front office functions, you had sales and trading, and then you also had equity research. So these people are brought over the wall for specific events. It could be like an IPO, it could be a fundraise or anything like that. They're brought into the tent. Now, equity research, what is it? It's essentially a function where you write a research report on a public company, a public stock, and you're essentially the mouthpiece for the company to the market. Now, the market are investors, that's the buy side. So basically, it's when the buy side are looking for investments. They've got money. Let's say it could be a pension fund, it could just be, I don't know, any type of fund, and they've got money to spend. They're like, all right, cool. We're looking for some stocks to invest in. Which stocks do we go for? They will often use research reports from these equity analysts, so from different investment banks who have close connection with management at these public listed firms. So they're able to get a bit more information in terms of a real understanding of the business. And equity research people generally know so much about the business because they meet with management maybe once or twice a month. They'll go to all of their results presentations, and they'll ask questions there. They will also be involved, very involved in terms of if there's any block sales going on, or if there's any deals such as like fundraising going on. The equity research analyst plays a very relationship heavy role without actually knowing it. And prior to MiFID II, so MiFID II was a standard that came in because essentially what banks used to do through their equity research arm was they would basically like big up a firm, right? So you'd big up a firm being like, oh, this is a sick firm to buy. And then the buy side would be like, all right, cool, we want to buy this firm because it was read your report. And then you'd get trading commissions on the back of that through, because usually they'd be trading through your bank. So you'd basically, I don't want to say hoodwink, but you're basically being like, yo, this stock is sick, so you should buy into it right now. And obviously, and we can do all the trade for you. So then some company will be like, oh yeah, cool, yeah, we'll do that, yeah, that's fine. And they do it through you, and then you get the commission on the trade. Now, in order to sort of get rid of that and bring sort of an independence into that, MiFID II was a regulation that was brought in to sort of get away from it. So now all research is paid for. So you have to pay for research up front, and then it's up to your due diligence whether to either trade on that stock or not. And what you usually see is that the best analysts will try and be as independent as they can to the market. Now, the company might not like that. The company might be like, you know what, we don't want to work with this analyst because they're always giving us crap forecasts and whatever. But at the end of the day, if it's all about how believable the analyst is to the buy side, that's all that really matters, because you want to have the relationship with the buy side more so than the company, it's also depending on if the company is your client or not as well. So let me now give a breakdown in terms of their role within revenue generation within the bank. As I've mentioned, the revenue generation comes from the buy side, in terms of the buy side have to pay for research reports to the sell side. So in order to receive these reports, they're going to have to pay the bank. So for instance, I was at Stifel. I don't know, let's say a buy side company, like a small one, for instance, I don't know. Let's just say Schroders. Schroders not small, but let's just say Schroders, right? So Schroders like, okay, cool. We want to receive some research reports from an analyst from Stifel, because we like the sectors that this person focuses on. So we just need to see this sector because it fits in with our investment thesis for our fund. Okay, cool. So now they will pay us maybe a retainer of 100 grand, whatever it is, for a year. And we will send them research reports on a bunch of different companies whenever they come available. Now, that is the revenue generation on the sort of direct revenue generation. Now, the indirect revenue generation comes from being able to have a relationship with the actual company, and then being able to, from there, get on specific roles as an investment bank with the public company. So, for instance, I was in corporate broking and ECM, which meant that as part of my role, we would be brokers to these public companies. So as a broker, we would get a retainer fee, and we'd also be in a prime position if there were any fundraising or if there was any M&A going on. We would be in prime position to get a role on that. So to help facilitate that, by having a good relationship with the research analysts as well, that can really bring in you guys as like a corporate broker and ECM public M&A function into a deal just through the relationship between the analyst and the company. Let's say, for instance, if it was getting taken over and you managed to land a sell side advisor role, and say if you could potentially make like, if it's a fairly small company, maybe like 4 or 5 million on fees through that. And that's like an indirect revenue stream that has been generated through your equity research, if that makes sense. And then as part of ECM deals, now, because if your equity research analyst has lots of good relationships with loads of the buy side, whenever we're fundraising, we'll be able to reach out to those, because through the equity research analyst, who will then bring in these buy side clients, and we might be able to get in bigger checks from them for the overall deal. So, and then we make a percentage on those fees as well. So there's like different ways that equity research actually brings in revenue into a company, but the most direct one is just paid research to the buy side. What kind of skills are needed for an equity research analyst? So, modeling and presenting and pitching an idea is what you're doing essentially. When I'm talking about modeling, it's not so much like the amount of modeling you would do for an M&A role, where you have to think about different ways to finance a deal. So you'd have to look at like an LBO analysis and things like that. Then that doesn't really matter for this, for instance. This is more about, okay, for instance, what could the valuation of this company be in 5 to 10 years time, depending on this growth rate. So it's basically just you could do a DCF. Valuations are used a lot. Multiples are used a lot when you're looking at peers. Peers are really important in the valuation that you have to come up with for an equity research report, because especially like, for instance, if you're IPOing a company, you have to think, whereabouts does it fit in the market? What would our valuation be? And an equity research analyst can play a pivotal role in an IPO, when, for instance, like the investment bank has got a major role on the IPO. So, because that determines what value the share price goes at into the market when they first IPO at. So it does play a massive pivotal role. And in terms of the modeling, like, it has to be on point. And a good way to gauge it is actually, because usually for the bigger stocks, there are multiple analysts covering that stock. So if you're like within the consensus of that sort of target price, for instance, or the valuation of there, then you know that you're kind of in the right ballpark just by looking at the consensus. That's a good way to judge it. And then the other thing is the presentation. So essentially, there are reports that will be written, an A4 piece of paper, portrait, and usually the way it is, at the top you have a quick summary about what's going on, then you'll have an investment thesis, then you'll have your modeling, then you'll have like your cases for and against, and then your conclusion. And as part of that, you'll also have a target price, and you'll also have a recommendation, whether you think it's a stock that you should buy, whether it's a stock you should hold right now, or a stock you should sell right now. Loads of banks have different nuances on this. You'll see like overweight, underweight, and things like that. Overperform, underperform, but generally it's buy, hold, sell. And yeah, that's kind of what a research report looks like. Now, there are different types of research reports. So initially, when, for instance, if there's a new analyst taking on a new stock, the first one is usually called initiating coverage. This is usually a really, really long report, and it usually takes months and months for the analyst to actually do. They'll have multiple meetings with management, and they'll get feedback from investors as well on like a no-names basis sometimes. And from that, an analyst could write a report. Minimum I've seen is like 50, 60 pages. Maximum I've seen is over 100 pages. And it's just literally like a whole splurge, really in-depth analysis on the company, and initially where this analyst thinks that this company could go to. And then intermittently throughout the year, whenever there is a trading update, whenever there are results, whenever there's a major event, the analyst will also write reports on the back of them. These aren't as big as those. Usually the results one is slightly bigger. Maybe they'll be like 15 pages, 10 to 15 pages. You also have like flash reports if there's been like a small bolt-on M&A and they just want to get something out to the market. That could be like literally a one-page report. Trading updates, they could also be like a few pages of report as well. But because you're working in the public domain, these have to be turned around quite quickly. Generally, for instance, and that's why the flash reports are usually only 1 page or something, because you might get a phone call, because the thing is, you can only if you get consent from your compliance, you can bring them in when markets are open. Usually it's when markets are closed. So when markets close after 4:30 p.m, usually you'll have a call with the analyst saying, hey, we've just done this thing, or we're looking to launch a fundraise tomorrow morning. Are you able to get something out by 7 a.m? So the analyst will have to work a bit later that night, ensure this all gets signed off, and then it's released at 7 a.m. the next morning. So they're the kind of reports that an analyst will technically do. In terms of the hours that you're going to be doing, so as I've kind of just alluded to there, you generally, if there are events going on, you're going to have to be up fairly early, because 7 a.m. is when announcements go out. So when announcements go out, you could potentially get a lot of calls from the buy side to you. If you've got a relationship with those buy side investors, they will sometimes ring you up if they've been like, oh, what's happening? Just seen this trading up there, blah, blah, blah. Can you give me more info? So you're going to have to be clued up on that and be available, like I said, to receive calls from 7 a.m. onwards. Generally, if there's nothing going on, like you're probably doing like a 12-hour day, which is in investment banking, it's pretty good. Obviously, if there are things going on and you've got like, especially results season can get really mental if you're doing a few clients that all have results around the same time. That can be mental. When you're pitching for a client as a corporate broker, or like if you're looking to IPO it or something like that, again, that can be quite hectic. You can be asked to do a lot of things, especially with the IB team. So I worked with an MD who loved to bring in our analysts as soon as we could when we were trying to pitch to a client, and it meant that there was a lot of onus put on the analysts in order to do some work for us. To be honest, I would do a lot of the work, and then I'd just sort of soundboard it with the analyst, and the analyst were like, oh yeah, that's right, yeah. I was like, all right, cool, thank you. So yeah, it was really interesting for me, to be honest with you, just because personally I was like, it's like one of these jobs where generally you're kind of chill throughout the week, but then it can just turn on its head like this and you're like, oh shit, now my evening's gone. You're expected to go to lots of presentations. You've got to be able to ask decent questions as well at Q&A. So a lot of these companies, when they have their half-year results and full-year results, they'll hold presentations where you as an analyst, equity analyst, are expected to ask a few questions. Especially if you're the house broker, you're expected to know so much, and it's your reputation on the line at the end of the day. Now, one thing I will say is that a lot of people talk about how to get into equity research. The thing is, it's not a very fluid market to get in and out of, and that's because when people are in it, they're usually in it for a fairly long time. And getting out of it is because you're not deal driven. There's not many people that go from like equity research to PE. I've not seen anything like that. So the exit options are fairly limited compared to being in like an M&A kind of role. And then the entry options, I think for this role, I think doing the CFA would help you a lot. I'm not going to lie to you. Like, CFA is more so for the buy side, but for this kind of role, like equity research, because there is a lot of similarities between equity research and investment analysts on the buy side, which I will discuss in a later video, doing the CFA would be helpful. Now, I always say doing the CFA is a massive commitment. I'm not saying you should do it because one, it costs a lot of money. Two, it literally takes ages to revise for. Something that you could do, like I said, it's more buy side. The IMC is quite helpful. It's like a precursor to the CFA, and it doesn't cost nowhere near as much, and you can probably do the whole thing within 8 weeks. However, if you're coming from like an audit background, having the ACA can be really helpful as well. So please do look at that. I think there's a few different things that you can do, but because at the end of the day, it's all about the way you present. You've got to be able to talk to people. It's a relationship role, but at the end of the day, you've got to be able to distill information and describe a company in a way that the most simple of investors, like generalist investors, especially if you're going more the generalist route, are able to understand. They need to look at your research report and be like, oh, this guy knows a company, or this girl knows a company. But also on top of that, it's about being credible with, if you think you should buy, hold, or sell, your recommendation comes into it, and your target price as well. If your target price is super high compared to the rest of the market, people are going to be like, this guy does not know what they're talking about. So there are different things you have to sort of cater to, but I think that comes with experience as well. One thing that I've seen is that generally the best analysts always have a really cool head on them, and also I feel like they're very true to themselves and don't play up to the company too much, because and you challenge the company. Because if you just play up to the company, yes, some companies might like that, but you'll lose credibility with the market in general, with your investors. So yeah, the best analysts, like I said, I've worked with, honestly, they're just very brash. Well, not brash, but they're very like, they don't hold back in terms of, oh yeah, we're just going to butter this company up and blah. They're not like that at all. They try and be as independent as they can, especially to our side when we're like, yo, we're trying to pitch this client, can you make them look good? No, the best ones that don't do that. Anyway, I want to say thank you all for watching. We're going to end it there. Please remember to subscribe, like, share, comment, all that good stuff. Let me know what you want to see from me next. Put it in the comments below. I will be getting around to everyone's video ideas. Like I said, I'm trying to go do this on a weekly basis. I've not actually missed a week. I'm also trying to hit 1,000 subs as soon as I can. I'm trying to get to 4,000 watch hours. Quite a long way off that. So just have this on repeat in the background. But yeah, hopefully see you next week. Peace.